Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Bootcamp. I'm your host, Whitney Elkins-Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm so excited you have joined me today. We are going to talk about end of the year tax moves for high net worth individuals. Now, if you haven't joined a bootcamp before, we do this monthly bootcamp to help you deep dive into a skill. And this month's skill is prepping for the end of the year. Now, a lot of what we're going to talk about today doesn't just apply for end of the year tax moves. And this actually should be for 2024, but we can actually apply these tax moves for our tax preparation in 2025. Now, if you don't know me, again, my name is Whitney Elkins-Hutton. This is the whole reason why I invest in passive real estate. And passive real estate can afford you one of the best tax shelters that we're going to talk about to help create velocity with growing your wealth. Now, wasn't always like that. I actually started off investing back in 2002 completely by accident, and then started scaling through living, flipping, and house hacking, and then eventually into single family rentals. And then purchased that multifamily building, realizing active involvement on my own just wasn't for me. So got into partnership on some larger projects. But really, my investing passively is to serve one thing, and that is so I can spend more time and have freedom and control of how I spend my time. So I can actually give back, not only to my family, but to you guys here. This is what I love doing. This is my passion, is educating investors on how to leverage this amazing asset class so you can go out and create that impact in the world that you were meant to create. And we can help you do that here at PassiveInvesting.com with over $331 million raised in our real estate debt fund, and then over $1.4 billion assets under management, and strong returns to our investors. Now, today we are going to be talking about taxes, but remember, these webinars are actually educational purposes only. So what we talk about here should not be construed as financial advice, tax advice, legal advice. Okay, really how you should take this information is ponder it and then take it back to your team in order to formulate a plan that best fits your situation. Now, if you haven't done so already, make sure to check out PassiveInvestingWithWhitney.com. There, I've got some free goodies for you. You can also hop on my calendar and we can talk about how passive investing can actually help you achieve your investing goals. And I would be remiss if I didn't mention my book published with Bigger Pockets called Money for Tomorrow: How to Build and Protect Generational Wealth. There is a whole chapter on tax savings, and a lot of those things we're going to touch on here today. All right. Now, I tailored today's conversation specifically for end of the year tax moves for high net worth individuals. Now, this should not replace you actually, partnering with an accountant or a tax strategist to figure out what tax moves should happen in your situation. And this is not an exhaustive list, okay, to say the least, but we're going to go over some of those key things that I know that everybody, if you've done no tax planning for 2024 year to date, you can actually get some of these done before the end of the year and actually have a huge impact. Now, the key to any great tax plan is to actually plan before you actually need it, okay? So right now, you're at the end of 2024. This is not the time to create a tax plan for 2024. We're creating some Hail Mary moves, okay? So tax planning should actually happen the year before you want to execute on it. So in theory, you should, and I'm encouraging you to find a tax strategist, an accountant that specializes, and if you're here, probably in passive real estate, so you can create a plan for your moves in 2025. All right. Now, that's not what most people do. They try to save a buck and they try to, gather all the information from books and webinars and stuff like that. And that's fine. But again, we want to make sure that you have a tax plan tailored for you. And that leads me to my second point here, is that you should always involve your tax strategist and or accountant. They may be two different people, guys, in any major decision. That means if you're buying property, investing in property, selling property, you have a property or an asset that is selling, you're repositioning something, refinancing, you've got, whatever major, tax or, money event happening, you should always involve your accountant. Now, a lot of times accountants want to pay you, have a retainer program for you to contact them. I personally love finding tax strategists and accountants to where I can pay by the hour, because it might just be a simple email being like, hey, do you agree with what I'm trying to do here? All right. Now let's dive into top 10 things that you can do before the end of the year to realize, some tax savings, right? Essentially impact your tax liability. Now, number one is make sure that you're taking advantage of accelerated depreciation. All right. This is one of the reasons why us as investors love real estate, is because of depreciation. But it's not just, the IRS gives us several different ways to account for depreciation, really two different ways. And then we also get an incentive on top of it called bonus depreciation. But the cream of the crop is us being able to accelerate depreciation forward. Okay, not just say like if you're investing in a multifamily building, or maybe even a single family rental or residential real estate, and you take your depreciation schedule and you divide it by 27.5 years, okay? But you can actually hire an engineer, okay, that specializes in cost segregation analysis, and they can go out and break down the property into all of its various components, accelerate forward anything that depreciates in 20 years or less to the first 5 years of the project. Okay, that can help shelter a ton of income for you and create velocity in your dollar in order to scale your portfolio quicker. So some key things before the end of the year, kind of any of your tax moves, if you need more depreciation, not everybody needs more depreciation, but if it's something that you actually need, consider investing in a property or an asset that throws off depreciation. Now, here's the thing. A lot of people get a little skittish about investing in property before the end of the year because they're like, how in the world are they going to get the cost segregation done? Here's the thing. You don't have to complete the cost segregation until the next year. Okay. And you can even go back, you can even, do it in future years. Okay. And retroactively apply the depreciation. Now that's not nearly as smooth of an accounting process. Again, talk to your tax strategist on that. But if you're investing, say, in a multifamily project or express car wash, okay, that operator has until October of the following year to get that cost seg done. Okay, so that is a great way you can actually sign on the dotted line, as long as the property closes by 11:59 p.m. on December 31st, it can qualify for accelerated depreciation in that tax year. All right, number two, execute a 1031 exchange. Now, this is a little, stickier to pull off. Not as easy, but essentially, if you have a property that has an immense amount of equity in it and you want to reposition that equity into a different asset, essentially play a little bit of monopoly, you could go ahead and start executing on a 1031 exchange. Now, here's the thing. You just have to start it this year. You don't have to finish it this year. Okay. All right. So essentially what you're going to do is you can sell a property, place the gains with a qualified intermediary, meaning you do not touch the money. All right. When you sell the property, it has to go with a qualified intermediary. And then you just have to identify the property in the next 45 days and close on it in the next 180 days. Now there's some like nuance rules here, but that's kind of the basic gist of, taking advantage of a 1031 exchange. Now, a 1031 exchange doesn't actually lower your tax bill, but can help save on taxes that you would have paid if you sold that asset directly. So essentially what we're doing is deferring that capital gains and depreciation recapture to future years. And, there's always the buy, borrow, and die strategy, meaning if you die with that asset in place, you might not pay that tax bill ever. All right. Now, here's some other tangible things that you can do within your real estate investing business. Go ahead and prepay some 2025 expenses this year, especially if you have high income. If you made more money than you thought you were going to this year, or if what you made is going to push you into the next tax bracket, think about prepaying your property taxes, insurance premiums for 2025, any repairs and maintenance that you're thinking about deferring to 2025. Get those paid and completed this year. All right. And any other qualifying expenses. That way you can bring your income down and essentially, take advantage of a lower tax bracket. All right. Utilizing the qualified business income pass-through. So if you have a qualifying sole proprietorship or a limited liability company or an S Corp, you could qualify for a 20% deduction on your income. That can actually help lower the taxes that you would owe on that income. Now, this is not necessarily a given, okay? There are some rules and exclusions there, so make sure to talk to your CPA if you qualify. But again, I think a lot of people get a little disoriented thinking that they can only qualify for QBI if they have an LLC or an S Corp. And this actually pertains to qualifying sole proprietorships. So talk to your CPA or tax strategist about that. Now, this is one of my favorite strategies is shifting income to kids. All right. So each child, okay, and this really can be a dependent, right? Like if you have parents living with you and they're considered a dependent of yours, you can take advantage of their income tax bracket if you would like, their standard deduction. That's essentially what we're doing here with our kids. We're taking advantage of their standard deduction, which is $14,000. So essentially, every child can earn up to $14,000 before they have to start paying taxes. All right. Now, here's the thing. What is a child like a 12-year-old going to do to earn $14,000 of income? Go out and deliver papers or, and that, it might be a little bit difficult for them to, acquire that income. But here's the thing. They can work in your business. They can do anything that you create a job description for. So I've had my daughter start filing paperwork. She's modeled, she's cleaned the office. She actually built a website for me this week. She's 12 years old. And man, these are teaching her business skills. But anyways, I can pay her for that. Okay. As long as I've created a job description and I have her either on payroll or I've paid her through a 1099 form. Here's the thing, you're going to want to, again, partner with your CPA on this to make sure you got all that I's dotted and the T's crossed, but I can actually pay my daughter. Okay, I get that as a business write-off. She gets to earn that income, doesn't have to pay taxes on it unless it goes over $14,000. But that's just half the magic. Okay, now she can pay for all the music and Squishmallows that she wants to buy. And I didn't have to pay taxes on that money. I don't have to foot that bill, right? I do as a parent have to provide a roof over her head, feed her and clothe her. But some of those ancillary things like sending her to camps, that is money that she can pay for, or an expense she can pay for out of that money. Now, if we're going to talk about real wealth generation though, I'm going to have my daughter set aside part of that into her Roth IRA. Remember, she has earned income now. And so she has a Roth IRA and she can now contribute to that Roth IRA. So she earned income tax-free. She contributed to her Roth tax-free. It grows tax-free and it's going to come out tax-free. Okay. You can really set up your kids, for retirement at a very young age by shifting your income to their tax bracket and leveraging that to generate wealth for them. Okay. But again, the goal here is to lower your income by paying the expenses, not to somebody else, but to your kids. You're teaching your children skills, okay? Potential business building skills, negotiation skills. Like she had to negotiate with me this week on what she was going to get paid to build this website for me. And again, now she can pay her taxes or expenses tax-free or begin growing her wealth tax-free. All right. Now, this is another favorite strategy of mine. And this applies to anybody, no matter if you're a high net worth individual or not, is maximizing HSA contributions, health savings account contributions. Now, this has a couple strings attached to it. Okay. So, but the big thing here is what we're trying to do is for any qualifying medical expense, you can contribute to this account, and essentially the income that you contribute to the account is tax deductible. It grows tax-free and comes out tax-free. Kind of sounds like a Roth IRA, guys, right? Well, again, you have to have a high deductible health plan. Okay, you can't just have any health plan. It has to be a high deductible health plan in order to qualify for an HSA account. All right. Now, don't just pick the plan, okay, just to get the HSA account. You want to make sure you're picking the health plan that's appropriate for you. But the cool thing here is you can contribute up to $4,150 per individual per calendar year, or $8,300 for a family to the HSA. It's not use it or lose it. Okay, this account, that money can stay in that account and continue to grow tax-free, and it can come out tax-free for medical expenses as long as you've saved your receipts. Okay, and here's the cool thing. You can also potentially invest your HSA. Okay, now some HSAs will require you to keep a minimum dollar amount in your account, say like $1,000, before you go out and invest in the stock market. Or if you rolled it over to a self-directed HSA, invest in a real estate asset or something like that. Okay, again, partner with your tax strategist to see what's appropriate for you. But this can be a very powerful way, not only reducing your tax liability now, saving on your healthcare related expenses, but also building powerful wealth for the future. All right, next, tax loss harvesting. Okay, the last couple of years have been pretty rough for investors, no matter whether you've been in, equity investments, perhaps even in the stock market. Okay, there have been people that have made money, and of course, there's been people that have lost money. So be sure to harvest your losses. Now, if you have an investment that you have a loss on, you could potentially use that loss to offset other investment gains in your portfolio. And then once you have used the losses to offset the gains, say like you still have more losses on the books, you can either book them and roll them forward, or you can, depending on where your adjusted gross income lies, you can use up to $3,000 in excessive losses to offset your ordinary income. Now, here's the thing. You have to have proper documentation of the investment loss. So you can't just say, yo, I lost money this year, trust me. Okay, you actually probably have to get some sort of documentation, like account going to zero, or a fair market value letter, stating a zero loss, or get legal action, take some sort of legal action in order to document the zero, your investment going to zero. Okay, but once you have that documentation, there's several different ways you can get it. You can now work with your accountant on booking the loss. And if you have excessive losses past your gains, you want to make sure your account is booking those appropriately. Okay, not losing track of those losses. They're precious. It's kind of like you want to make sure your accountant is appropriately booking your depreciation for all your investments, because that's precious too. If you have excessive depreciation, it can carry over to the next year. All right. Tax credits. Now, there are several standard tax credits that, a lot of, real estate individuals take advantage of. I put some of the tax credits here that probably tilt towards a more high net worth individual. So, I mean, we have like our child care tax credit, we have our savers tax credit, right? I'm just kind of talking about those ones that it might be like residential energy credit for maybe adding solar panels, some sort of renewable energy source to your home. Electric vehicle credit. Okay, if you bought an electric vehicle, you could get up to $7,500 for a new EV, or $4,000 for a used one. You can get business credits, like research and development credits, work opportunity and tax credits. Okay, this is great if you're a business owner. And then you can also get the opportunity zone credit if you're investing in qualifying opportunity zones. All right. Now, next to last one that we're going to talk about is charitable donations. Okay, so we all know that you can donate money, you can donate items, and take a write-off on your taxes. You can also donate, if you were going to donate to an organization, especially a substantial dollar amount, if you were going to donate anyways, you can donate various assets in your account potentially. And most organizations will take stocks, bonds, and mutual funds. But what happens here, instead of you liquidating the stocks, bonds, and mutual funds and realizing a capital gain and then having to pay taxes on it, you could actually donate the stocks, bonds, and mutual fund to that 5063 organization, and then they can liquidate it and they don't pay taxes on it. Okay, so that's kind of how that works. Okay, you could get the write-off, not have to pay the capital gains and the taxes on that liability, and then the organization, benefits from being able to liquidate that and not pay taxes themselves. All right, the last one is Roth conversions. Okay, so once you kind of got all of these things in place, you're going to partner with your CPA and tax strategist and go, okay, where are we landing for the year as far as where we think my adjusted gross income is going to be? Now, I know this is the end of year tax move. We've got essentially, 6, 7, 8 weeks before a lot of people are going to be off for the holidays. So if you're going to execute on this, get on it now. But if you know you're going to be in a higher tax bracket and you have worked to get into the lower tax bracket, you might consider working with your CPA to figure out how much space you have left in that tax bracket and go ahead and roll over part of your retirement from the traditional side of your retirement accounts to the Roth side of your retirement accounts. Okay. We don't want to move so much that it triggers you moving up a tax bracket, but really taking advantage of how well you've organized, how well you've planned in order to be able to take advantage of those lower tax brackets. And this is particularly important for individuals that think they're going to be in a higher tax bracket at retirement. They should consider going ahead and doing this now. Okay. Yes, we've talked about end of the year tax moves. How can we lower our liability? This Roth conversion will actually trigger a tax liability for us, but any future withdrawals though on that money will then be tax-free. Okay. And this is particularly important if we think that tax rates are going to increase in future years. All right, guys. Again, as I mentioned at the beginning, all this is predicated on actually good planning, okay? So we can throw those Hail Mary passes at the end of the year. There's a lot of things that we can do to impact our tax situation, but there's nothing better like having a good plan up front. So I highly encourage you to do two things. If you haven't already met with your CPA and tax strategist to understand what you need to do before the end of the year, okay? Go ahead and get with them now to figure out what you need to do in 2025 and get that plan in place. And one of my favorite books out there, we've had Tom Wheelwright on the show. He's the author of Tax-Free Wealth. This is kind of his 5-step game plan here. Reducing our income through strategic deductions, converting how income is earned, shifting income to entities, eliminating income through credits, and then looking at deferring income through qualified retirement plans. Now, if you go back and rewind today's video, all of these tax moves that we lined out today line up very well with Tom's plan that's outlined here. All right, guys, we're about to move to the Ask Me Anything part of the show. But before we do so, this is your invitation again to join me at PassiveInvestingWithWhitney.com. There, I've got some freebies for you, and you can get access to future masterclass and boot camps like this. We're about to start our Ask Me Anything part of the show, guys. All right. What questions do you have? Guys, I'm not an accountant, but I'm happy to give you kind of my, 2 cents on things. I'm going to exit out of here. Again, we've got lovely Zoom that doesn't play very well sometimes with me. All right. Can I show the first slide? Yeah. That would be my, let me go back here. I'll show the first slide. So the first slide was just like what we're talking about today, end of the year, the tax moves for high net worth individuals. I said 2025, it actually is 2024. I leaped ahead a year because I want you guys all planning, not doing things, retroactively. All right. Can you show the slide about 1031 exchanges so I can see the prepay option? There's no prepay option. I don't know if what you were talking about there, Terry. So if you want to go ahead and expand on that question. So we talked about two different things there. We talked about prepaying expenses, and we also talked about doing a 1031 exchange. And so in the prepaying expenses, it's any qualifying business expense that you can justify moving forward to this year. So think about it. Property taxes, if you're gonna hold your property, if you're not selling it this year, you can justify paying property taxes, insurance, any repairs, maintenance, and stuff like that this year. Okay, because you're realistically carrying it for the next year. Okay, you can talk to your CPA. There might be some other expenses within your business that you can pay, right? Like we talked about things related to real estate, but this also relates to business owners, right? If you have taxes in your business, taxes you need to pay, if there are insurance premiums that you need to pay in your business, if there's repairs in your business, maintenance, stuff like that, you can go ahead and accelerate those forward and pay those this year. If you had like a really good year and you need to offset some income and pull yourself down a tax bracket, that is a strategy. That's a very useful strategy. Now, the 1031 exchange is different. That's where we are essentially selling property that has equity in it now and trading up for either a larger property or multiple properties. And so what we want to do is not pay gains on the equity or pay depreciation recapture. So that's the 1031 exchange. Somebody asked, can we get the slide deck? I generally don't share slide decks because everything is posted on Zoom. So you can go back and rewind this video as much as you want. You can see the commentary attached to each of those slides. Okay. Can passive activity losses like depreciation and loss from the real estate syndication investments offset short-term, long-term capital gains? It depends. You need to partner with your tax strategist. Typically, passive losses offset passive gains. Active losses offset active gains. But if you qualified as a real estate professional, which is kind of hard to do at the end of the year, that's something you have to plan to do at the beginning of the year. So I'm going to have a sister webinar here at the beginning of 2025 to talk about kind of like tax planning moves that you should kind of have in place for 2025. That would be one of those things, planning to be a real estate professional. Then you can use those losses more readily. Now, still going from passive to active, active to passive, that is going to really depend on, what your CPA says your tax situation is. And here's the thing, if you have a CPA that says, I don't like utilizing depreciation, it's too risky, you're going to get audited, and they won't even book depreciative losses for you, you need a new CPA. That's all I'm going to say about that. What options do you recommend to reduce W-2 income taxes through passive investing? Does car wash investing qualify for this? The best way that I know, again, guys, not an accountant, just have a long history in this, and have made a lot of mistakes myself, and learned from them. The best way to reduce your W-2 income is going to have you or your spouse qualify for a real estate professional. And like I said, it can be you or your spouse. There's certain guidelines there. If you're going to have long-term real estate, I think that the hours are 750 hours. That you have to have in real estate, and you can't have more hours in real estate or more hours in a W-2 job than you do in actual real estate. So there's some cookie things there that you need to pay attention to. You have to document everything. It has to actually, your role can't just be reviewing finances. Your role actually has to be active management of these assets. Now, another way to qualify is if you have short-term rentals. Okay, there's some thresholds there. They're a little bit lower than the passive real estate, the hours required for if you owned a passive real estate portfolio. Because if you have short-term rentals, if you're actively managing them, you've got hospitality attached. You're managing the customer, responding to them, turning the unit, maybe even supplying services to them as well. Now, does car wash investing qualify for this? If you're investing as a passive real estate investor into an express car wash, more than likely not. Okay. Again, you're going to have to partner with your CPA to figure out if there's a way they can unlock those losses for you. More than likely not. But if you own your own, say, coin operated, car wash, like say in your town, maybe you can unlock those losses against your W-2 income. I can see that because now you're actively involved, not passively involved. Right. So again, I would heavily partner with your CPA to figure out that. But let me think on that and see if I come up with some other ways to reduce your W-2 income before the end of the show. Now, tax loss harvesting is another way to reduce your W-2 income. Passive losses, if your adjusted gross income is, I believe it's $150,000 or below, the threshold may be a little bit higher. You might be able to use up to $25,000 of your passive losses to offset some of that income. So it really depends. But again, your CPA is going to be able to identify those for you. Will we get the recording? Heck yeah. All of our recordings are always posted on YouTube. Give us about 24, 48 hours. We'll have that up for you. If you registered, which you guys are here live, you did, you get an email recording as well. Can you count the hours spent for researching and managing LP investments in real estate? And I assume you mean towards rep status. I would always document that and talk to your CPA. I think because you're not, this is the gray line, right? Like, the IRS has written the tax code, right? The first, say, like 10 to 14 pages are all the different ways of all the ways that you have to pay tax. The other 300 pages are the ways that the IRS is telling you not to pay tax. If you do this certain action, you can reduce your tax liability. Okay, so essentially they're trying to tell you all the different ways that you can partner with them. One of the ways that you can partner with the IRS is solving housing and business-related problems. That's why we get accelerated depreciation, we get the 1031 exchange, we can, unlock passive losses against active income if we have rep status. Now, here's the thing. As a passive investor, if you're researching limited partner investments, that you're not, what are you doing? You're not really, the operator is solving the problem, not necessarily you. Managing, now, if you're talking about managing your own portfolio, again, that's within your own real estate business, not necessarily, tied directly to the property. Here's the thing. I know of passive investors that have documented all of this and have their accountants have taken the rep status for them. I cannot say that you can do this. It's not very black and white. I think it boils down to whether your accountant will allow it or not. And here's the thing. The question isn't necessarily if your accountant will allow it or not. It's if they will defend you in tax court or not for that. Okay. Now I know one of our managing partners, he's all about that. He was like, yeah, if a limited partner investor is a full-time limited partner investor and they're researching and managing their portfolio, he goes, heck yeah, they should be partnering with a CPA that allows them to do that. It's just a matter of finding one. Somebody said you can be a rep, real estate professional easily if you have no W-2. Yeah, you overcome that the rule that you don't have any other business activity or job activity. That's pretty easy, yes. But a lot of people, if you're investing, and well, here's the thing. This is what usually happens. What I see. I started hitting rep status because my husband was working, I was unemployed. So I was concentrating on all of our investments in our portfolio. And then when I went back to work, I very purposely went back to work in real estate. Yeah, like it was easy to hit rep status that year because I just had to hit the 750 hours and make sure that it was active management. So totally agree with you there, Alicia. Does passive income through syndication increase my tax bracket? I mean, it's added income. I'm trying to think through this. I mean, I think if you're not getting any so if you're in an equity deal, right? We can be in equity, we can be in debt. I'm going to talk about the way that I know for sure it's going to potentially affect your tax bracket. Like we have our real estate debt fund. Okay. The real estate debt is taxed as ordinary income because you're on the debt side of the business. You're the bank. Okay. You don't participate in the depreciative losses of the asset, so that income gets booked as ordinary income. If you earn so much that it pushes you into the next tax bracket, sure. Now, here's the thing. I don't let the tax tail wag the dog. If that's the only lesson that we have learned over the past 2 or 3 years in this high interest rate environment, do not let the tax tail wag the dog. You have to have a diversification, not of operator, market, and deal, but also in the capital stack. You have to have diversification in the capital stack. Okay. We used to be told that if you invested in the stock market, you needed, 60% equities and 40% bonds because they were uncorrelated, right? That did not hold true in 2022. Like if you were holding stocks and bonds in your portfolio, you were hurting. Okay. But in real estate, we can see diversification in the capital stack. So we want to have equity investments that are going to be tax optimized for us. And then we have our cash flowing assets. Okay. And the cash flowing assets are there to kind of provide stability and smooth that ride in the portfolio. Okay. I'm going to step down off my box here for a second. Logistically, yes. Investing in those debt on the debt side of things, it's going to be ordinary income. It's going to increase the tax bracket. Now, if you go into the equity side of things, you should be investing with an operator. Like what we do is that we do cost segregation on all of our deals to throw off depreciation, especially accelerated depreciation for our investors. So it offsets the income. So those equity deals should not, if you're with an operator that's doing it properly, you're not going to see the accelerated depreciation is going to wipe out the income that it's bringing in, and it shouldn't push you up a tax bracket. But at some point in time, you're going to deplete those losses. And if you're still holding the asset, you're going to have income coming in. Okay. This is where I totally tell my investors, you should, if you're going to get in the passive investing game or a private equity game at all, you go in with the mindset that you're going to do, at least a couple deals a year to continue to replace your passive loss bucket and continue to kind of kick your tax income, tax liability down the road. Okay. But again, take home message here, do not let the tax tail wag the dog. Do what makes sense for your goals, risk tolerance, and timeline horizon, and make sure that you've got good asset allocation and diversification. Okay. Not just across asset classes. This is where I saw a lot of investors get in trouble, guys. Sorry to go down a rabbit hole with you, but this is super important. They said, I'm invested, I'm allocated across multifamily, self-storage, mobile home parks, and a couple other things that are equity, but they were all equity deals. Okay. They weren't diversified across the capital stack. All right. Next question. A follow-up question. Are capital gains losses considered to be passive, and can they offset other passive activity losses, such as losses reported in K1 from real estate syndication investments? Yeah, we already touched on this question. Capital gains and losses in a deal can be considered passive. So you want to know upfront, are the gains and losses in this deal going to be passive or active? Because there's ways to be in a deal. Like, I know a short-term rental fund. Now anybody that invests in the fund is considered passive, right? In their time, but the income that it's producing is active. So from a tax perspective, they are not passive, right? So you need to know upfront in the deal if you're active or passive. But let's say you're in a multifamily deal with us, self-storage deal with us, considered passive, right? And so your passive income's coming in, and then all those losses and capital gains are considered passive. Okay. All right. Many CPAs aren't strategic and will not take the time to do this, but you won't know until it's too late. Oh, Alicia, yeah, I 100% agree. So here's the thing. There are accountants, right? I demystified accountants in a webinar back, I think in March or April. And there are some accountants that that don't do real estate at all. Okay, just because somebody is an accountant or CPA doesn't actually mean they're the right fit for you, that they know what they're doing from either a tax preparation standpoint or real estate standpoint. So we want to make sure we're looking for an accountant who is versed in real estate, prepares taxes, okay, does the tax preparation, and will guide us on strategy. Okay, not just at the time that we're filing, but actually the year before, actually meet with us. Now, there are organizations out there, like we had Tom Wheelwright on, he has his Wealthability Network. That Wealthability Network, you pay a lot of money to get in it, and you're putting them on retainer for the year. There are other tax organizations, like Keystone CPA. You pay a lump sum for the tax strategy. And then if you need more meetings throughout the year, you can pay extra, kind of a la carte. Hull CPA is another one that we've talked about as well, or we've had on the show. But again, you want to make sure that you're with a group that will not just prepare your taxes, but actually sit down with you. I prefer to find tax strategists that you just pay by the hour. And if you pay for tax strategy, you can probably get that CPA to write out the whole tax strategy. And then if you're like really attached to using like a TurboTax or H&R Block organization, you could take the strategy to the other organization and get a lower tax preparation bill. Okay. But the tax strategy is where it's at. If I invest in a syndication that on the first of the year will provide a K1 with loss or depreciation cost segregation, can I have an idea in advance of how much will that loss be, so I can calculate it before the end of the year where I'm happy standing in order to know what to apply? Anyways, I think I know where you're going with this question. Yeah, yes, possibly. Okay, so I think anytime an operator goes into a deal, remember they haven't done the cost segregation analysis, but they may have an idea that a range, like if you invest in this deal, given accelerated depreciation and what we think is going to be bonus depreciation this year, they might say, hey, we think this is going to throw off 30 to 50% investment loss, or 40 to 50% investment loss. And so you're not going to get an itemized accelerated depreciation bill, so to speak, but you should be able to, kind of ask for a range of what they are eyeing for a potential loss. Now, it's not done until the reason why it's hard to give investors an exact number is because of two things. One, the cost segregation may not have been performed, so we don't know what losses are being thrown off. Remember, like if the asset closed on December 31st, that organization has until October 15th, technically, to get the cost seg done to take it in the previous calendar year. Two, it's not the losses that pass throughs to the investor aren't going to be set until the partnership K1 is filed, meaning that year, that tax preparation year, when that K1 is filed, that's when they're going to be able to tell the limited partner, hey, this is what your losses are. And so I've seen operators give out model K1s and get in big trouble because they didn't hit the mark. So for us, we want to, kind of give our investors what we're eyeballing for a range for depreciation losses, because we have an idea. But then we're going to wait for that partnership K1 to come out, and that's what you're going to take to your tax preparer. Now, here's the cool thing is you have the first year, you're going to kind of eyeball it. And then after that, you kind of have a really good idea based on that K1. Your tax preparer or CPA can say, yeah, this is what we can really expect for years 2, 3, 4, and 5. And then what we expect in, if the hold goes beyond five years. And they can really help you understand how that's going to impact your particular situation. All right. We have room for a couple more questions. If you guys have any more questions, jump in the Q&A box. I would love to get those answered for you. But great questions, guys. First of all, I always love to know, was this useful? Did you guys pick up a nugget today that you're going to apply to your tax situation? If you did, I want you to write it in the box. What was the one thing that was kind of like, aha, I need to do that? Drop it in the Q&A box or the chat box. I would love to know. And then, so what did you love? What would you love to see? Okay, because it's only when you guys tell me what you would love to see that I can actually provide you that valuable content or improve upon this for the future times that we run the content. Somebody said very useful. Great. Yeah. What did you take home? Because that also tells me, like, how did you assimilate the knowledge too? Ooh, somebody said the clue about research and development expenses looks worthwhile in investigating. Yeah, like especially if you're a business owner, I would partner with your CPA, see what you could potentially deduct this year, but especially planning for next year. If you are developing a new product, researching a new product, what can you deduct there? That can be a hugely powerful thing. Oh, thank you. Somebody says, thank you. Understanding investor relations, understanding capital raising process, understanding the capital stack ranges. Oh, okay. So that's what you'd like to see, Alicia. Thank you so much. We can definitely add that to queue. Somebody asked, if you have an S corp, I heard it is hard to charge the home office rent fee as you have to show this fee as an income as owner of the house. Is that correct? Great question. Not an accountant. I would partner with your CPA on that. I typically take the home office deduction, but my personal business is not billed as an S corp for various reasons. But I would partner with your CPA and ask what they're able to do for you. And knowing that up front is going to help you plan for sure. Somebody said, thank you, provided clarification on some tax concepts. Yeah, happy to help, guys. All right, so we will see you on our masterclass next week, and then on our boot camp, here in November. If you guys have any questions, be sure to reach out to me. In the interim, my email is whitney@passiveinvesting.com. Otherwise, guys, thank you so much for taking the time out of your day and spending it not only with me, but investing in yourself. Take care.